Hey guys, welcome back. This is episode 3 of Profit First for Contractors here on Builder Funnel Radio. Got Shawn with me again. Surprise, surprise, we didn't switch up the guest in this series.
Yeah, thanks for having me back. After that last one, I didn't know if you were gonna, continue the series or not. So I appreciate you.
For those that listened to the last episode, we covered a lot, so maybe let's recap it. If you haven't listened to that episode, you'll want to hit that one first. So go back to episode 2 before you listen to this one, even though this one has started off fantastic. But
yeah, like you said, they'll just fix it. They'll fix it. So just to give a quick review of what we're talking about in this one and how we got here is we're talking about the Profit First for Contractors 4-5-3 framework. So you have 4 core principles, 5 foundational bank accounts, and then 3 rules. So it's a combination of all of those things working together that helps you implement the system. So very quickly, the 4 core principles that we talked about in the last episode were small plates, serve sequentially, remove temptation, and enforce a rhythm. That leads to the 5 foundational bank accounts: income, profit, tax, owner's compensation, and operating expenses. So if you're not up to speed on those, after it's okay. Finish this episode out and then go back and listen to that episode, and it'll be totally clear. And so in this one, we wanted to talk about the 3 rules of Profit First for Contractors.
Yeah, and I'm excited for this too, because I'm sure there's some interesting reason why you're not counting up like 3, 4, 5. You just had to make it a little bit confusing here. We start with 4, we go to 5, but 3 must be magical. So what are the 3 rules? I know people kind of get scared when we have to dig into the finances, but do these things help us with that, or are they just like commandments of finance? Or
yeah, I like that. Maybe I should the 3 commandments. That sounds pretty
more
serious.
Powerful. Yeah. Well, marketer. So you're welcome,
exactly.
So.
You're much better at copy than I am. So really, the way that when I would start teaching this and when I wrote the book, so you won't find these 3 rules in the book, because the 3 rules really came out of me teaching this to contractors and appearing on stage and really helping it sink in. And so the 4 core principles, that came from Mike McAllitz's, and I built upon those. The 5 foundational accounts are just the Profit First system. And then as I taught this to contractors, I kind of developed these 3 rules because I realized that a lot of construction business owners thinking about like how to deal with their finances, how to understand them. And you hear it all the time that business is just a game. So I came up with these 3 rules, meaning like when you start playing this game of business, when you're managing the cash, just like any game or any sport that we need to start off with some rules, the things that are going to kind of keep us in bounds while we're learning all of the particulars about how to play the game. So that's where the Profit First for Contractors 3 rules comes from. And they're pretty straightforward. And this is not only the key to implementation, but these are also the starting points. So rule number 1 is your income is 100% of your budget. That means that it makes sense. But and so people will hear that and they'll say, oh, okay, well, duh. Like, okay, that's not anything profound. Yeah, it's not profound. It's simple. But here's the problem that you might find if you're a construction business owner is you will look on your profit and loss statement, and your profit and loss statement at the very top has all of the income for your business listed there. And then you'll look down at the bottom of your profit and loss statement at this thing called net profit. And you'll say, okay, hopefully there's a positive number there. And you'll say, great, I'm profitable. Or your CPA will look at that number and say, yeah, you're profitable. Now you owe some taxes. But then you look at the bank account and you say, well, wait a minute, where's all the money? Those numbers don't match. And that's because when you're looking at your profit and loss statement, even though it shows all of the money that comes into the business, it doesn't account for all of the money that goes out of the business. It does account for certain expenditures in your business, cost of goods sold and expenses. I won't get into the details of that, but that's why we came up with the rule to say you have to understand where the other monies are going out of your business. But we start with saying, if let's, for example, you're $1 million in revenue. If you spend more than $1 million, 3 things are going to happen. You're either going to go into debt, which is not a good thing. You're going to steal money from future projects that are coming in, or you're going to take profits from a previous time period to pay for that. So that's rule number 1. Your income is 100% of your budget. If you
Yeah, I
spend
feel like
more than
that's
that,
kind of like you're going out of bounds, on a basketball court. It's like,
that
hey, you're operating within the lines here. So
that's right. That's right. But the problem is we say, okay, you might be spending more during any given period of time, like a smaller period of time, not that big of a deal. Week to week, meaning, hey, I just got $50,000 deposit in this week. We're doing great. I didn't get anything coming in next week, and some money went out. So if you were to look at a 2-week time period, you could be negative on the, but as you get out and look at the month or at the quarter, you could be positive. You could, and I find businesses operate, they have 2 or 3 really good quarters. And this is just a regular cycle of business. And then they always have a negative quarter. Every business is a little bit different. But there are positive and negative quarters, but hopefully they not only balance themselves out, but you're making money. So year over year, rule number 1 has to apply, or you're going to have some problems. So people are saying, like, it's just the reason that rule number 1 exists is because the profit and loss statement doesn't tell the whole story. And so you got to understand what 100% of your income is, so that you can project out and spend 100% of your budget. Now, let me back up and say, you need to spend 100% of your budget. And one of those expenditures is profit, meaning, so every dollar that comes into your business, that a certain percentage of that needs to be set aside or spent on the most important aspect of the business, which is profit. So that's where rule number 1 comes in. Like you
yeah,
said,
and
staying in
just
balance.
to drill in on that a little bit, you said, a lot of businesses have good months and bad months or quarters. Um, do you have recommended frequencies? Like, everyone should be doing monthly P&Ls and stuff like that, but are there red flags that trigger, at certain points for you, or is it just, hey, as long as we're on track for the year and we hit that, that profit number, we're okay?
Well, to give some people some comfort when they start dropping into and analyzing their profit and loss statement, you have to realize that, especially in construction, this is what I have found, and this is not industry standard. If you've read the book, I don't go about industry standards, but this is a rule of thumb. It wouldn't be atypical to find a construction company that has 5 positive 5 positive months, 4 flat months, meaning like you're just kind of breaking even, and then 3 negative months in a year. So
There's
if I
that
did my
five,
math
four,
right,
three
yeah,
again. Yeah.
yeah. Oh yeah. Hey, I didn't even realize that. Yeah. So in general, but at least that one was 5, 4, 3.
Yeah,
But
I'm glad you went in order. That's how my
yeah.
mind works. So.
But what happens is, if you drop into and look at the analysis of one of those 5 positive months, see, they're going to be so positive that you'll think, man, we're making a killing, right? But if you look at it, that's your lead up to your busy time of the year. Everybody has cycles, right? So
Mm-hmm.
if you drop in and you start analyzing based on one of those 5 really, really good months, you're probably going to have double the net profit that you would when the year ends up. So you got to make sure you understand, am I looking at a very busy time, a very profitable time in my business? Am I looking at one of those like, hey, we're coming out of the busy season, we have a little bit of lag here, this is one of those flat months? And then we all have those in our businesses where whatever it is. And for a lot of people in construction, it's around the holidays when people, especially for remodeling contractors or whatever, they don't, business is going to taper off a little bit. So you need to know where your negative months are. And if you can solve the problem and take a negative month and just get it to be a flat month, all of that money can go down to the net profit at the bottom line. So it's just
That's
understanding
huge.
where that cycle in business that you are.
Yeah, and I definitely like looking at the, month to month, but to your point, like, we're seasonal, we go in cycles, and so year over year can be helpful for identifying those trends. And you can look back at last year or 2 years ago and see where those negative months were and how negative they were versus the positive months to start prepping for those.
Yeah, and you can identify, like, when you take specific actions. Let's say, again, 5 positive months, 4 flat months, and 3 negative months, and then you're trending and say, hey, we hit 6 positive months this year, we're probably doing better. And we know what drove those things. Those things just don't happen. And so it becomes really powerful when you need to drop into and do an analysis every month and take a look at it. But when you start identifying these things, on a monthly basis, then you can look back and say, hey, the things that we tested out, oh, that builder funnel thing is working for us, right? So to make up for the last episode, hey, it's working for us. Let's go do some more of that. Let's go pour some more fuel, some more cash on that thing because it's working. And then you level up the business when you can identify those things. So all of that comes from rule number one and seeing where 100%, what is 100% of our income for this month, for this quarter, and for this year. And we gotta not spend more than that.
Yeah. And before we get to rule two, just to emphasize, I loved what you said is, hey, this is 100% of the budget, but you're going to spend all 100, but you're spending first on profit, then on taxes, then on owner's comp, and then your expenses, going back to the previous episode. So you're going to spend it all, but several of those accounts have a really, really important purpose to them. So
yeah, and for a lot of construction business owners, don't kid yourself. You're spending all of it anyway.
Right.
So that's why I say spend some of it on profit. And when I say spend it, you don't actually spend, you just put it in the bank account and then spend it on yourself, meaning, actually pay yourself, the owner, a profit.
Yeah, that's great. Okay, so what's rule number two?
All right, rule number two is you got to play the percentages. So it ties back to rule number one, meaning when you start divvying up the money, serving your business sequentially through the different bank accounts, you have to understand how the percentages of your business change over time. So an example that I'll use for this, and I'm just kind of doing math in my head, is to say, let's say that we have, $1 million in revenue, and we run the numbers on our profit and loss, and it shows our cost of goods sold are 83%, or we spent $830,000, right? So our cost of goods sold is 83%. I need to know what that percentage is and say, okay, did we make any profit at those, at that cost of goods sold? And the answer is probably no. That's a pretty high cost of goods sold. So we need to say, all right, but we know what the dollar amount was, 830,000. So we say, well, what if we could sell $830,000 for more than $1 million? That's what we did last year, and it gave us 83%. But if we took that same amount of work and we sold it for some dollar amount, I don't know that yet, but we said it was only 70%, then what would that revenue have to be in order that $830,000 is 70%? So a lot of people are like, oh my gosh, he's getting into numbers. But what I'm saying is
pick some easier numbers, Shawn.
Pick some easier numbers. Well, what I'm saying is that you didn't do anything except you just sold the work, same amount of work, you just sold it for a different price. That's going to change your percentage.
Basically, you're saying like, hey, if we sold the same work for 1.1 instead of $1 million, now we've got another 100,000 that's going below that because you still use the 830 for our
That's
cost.
Right. The 83% or the $830,000 is 83% of $1 million, but now we sold it for something more than $1 million. The dollar didn't change, but the percentage did. So the percentage actually lowers. And so the way for your listeners to think about that is, a lot of times when I see those high percentages, I start there and say, okay, how can we cut costs? And they immediately owners start thinking, well, I guess we could get more efficient use out of our materials. So that's good. You need to be doing that anyway. But they really start thinking, and it's hard. And they're like, well, I guess sometimes they say, well, I can let this person go. I don't need them. I'm like, well, again, that's trimming the fat. You should be doing that anyway. So I paint it like this and say, okay, your plumber gives you a price to do work and says it's $10,000 to do, his scope of work. And you're going to go back to him and say, hey, Jim, thanks for giving me your price. It's $10,000, but I've been listening to these guys on Builder Funnel Radio, and they said I need to cut costs. So I need to pay you $8,000 because I got to cut my costs. Jim, the plumber, is going to be like, see ya, right? Yeah. I'm going to go work for somebody else. So you're not lowering the dollar amount, right? You can't actually cut a lot of the dollars there. What you need to do is sell Jim's work, Jim the plumber, for $15,000 instead of the $20,000 or the $12,000, which is the difference between a 20% markup or a 50% markup. But it's simpler to raise your prices, and that's going to lower your percentages. That's a way that you, quote unquote, cut costs, by lowering the percentages. So as you grow, for example, on your expenses will probably get lower as you grow. And the same math works, meaning we may find that we'll spend more dollars on expenses, but the percentage of the dollars is lower because, again, we've hired the right marketing team, and now those dollars are producing more income than they did before. We're spending more dollars, but the return on that lowers our percentage. You have to know the percentages of your business and also of your industry. For example, remodeling contractors that, to have a healthy business, I'd say they probably need a 10% net profit before taxes, 10 to 12%, very healthy. A plumbing contractor, I would say, that has a 10 to 12% net profit is probably suffering because they're a service-based contractor, meaning they do they have a lot of calls, right? Looking at plumbers, electricians, HVAC, other specialized service companies, they can be in the 20, 22% net profit. And so a lot of people hear that and they'll be like, man, I'm getting out of contracting. I'm getting into plumbing or whatever. But there's a reason for that. General contractors do a lot of general things. Plumbing contractors, roofers, they do one thing. That's the reason their margins, their profits can be higher. Whatever your business is in your market, you need to understand how the percentages work. So you got to play the percentages, and it all has to add up to 100%.
Yeah.
Going back to rule number 1. If they don't add up to 100%, you're in trouble.
That makes sense. Yeah. And I like your examples too around the cutting costs. And then in some instances, your dollars go up, but your expenses are less. And again, it's all based on the percentage. But I heard this saying that stuck with me, and it kind of speaks to that. But there's a limit to what you can cut, but there's no limit to what you can charge or earn on the top end. There's always growth opportunity there. And so, yes, trim the fat, like you're saying, but you will hit a wall eventually where you just need, a core set of expenses to operate and operate at a high level.
Yeah. And it's one of those things that understanding or playing the percentages will keep you from going out and saying, okay, well, I'm going to buy a $35,000 truck. And then I'll say, okay, what's that going to do to the dollar amount, right? It's going to raise the dollar amount. And if that $35,000 truck doesn't raise your revenue, then you're going to raise the percentage. We got to get that $35,000 truck to raise it enough to keep the percentages on the expenses the same. And that hit a lot of people right there. They're like, Shawn, I want to go get that new truck, as opposed to getting a $7,000 truck. And I understand you'll say, well, it's branding. We don't want to show up in a clunker and all that. Hey, great. You're already starting to think and playing the percentages, right? $7,000 truck ain't going to do it because it's going to look, crappy or whatever. But a $35,000 truck, I can't justify that. And then we find our sweet spot and say, okay, I'll get a $12,000 truck, something that I can actually afford. Yeah. I can play the percentages with that one.
Yeah. I love that. That's awesome. And if you do all this, you can have the profit to then invest and grow. And eventually you can get the $35,000 truck that fits in the percentage. So, I'm again, at the risk of offending a lot of people out there, once you work really hard to make profit and you understand how the numbers work, you're playing rule number 1, you're playing by rule number 2, then you start looking at the $35,000 truck and being like, man, what a waste. Yeah.
As soon as I drive it off the lot, I lose $10,000, or whatever it is. So
yeah, absolutely. Okay. So rule number 1, we've got 100% of your income. That's your budget. And then we're going to play the percentages. And so what's the last rule or commandment of finance?
Yeah, the commandment. I like that. So here's rule number 3. And I'll tell your listeners, this does not serve my business as a business coach to drive this home, but this is where profit first for contractors starts, and it's the key to implementation. You cannot know anything about your numbers or understand the financials. Now, you still need to do that. You've got to understand and do the work, but you don't have to understand that to start. Rule number 3 is start small. So and the reason I say it doesn't serve my business, because I want you to get coaching from me. I want to work with your company. But if you go and start small, you may not need to. And so here's what it is. Start small. Let's say that you don't know what the numbers are. You've not made a profit. You're not setting anything aside for taxes. then you can start small. I say start with a goal so small it's impossible not to do. That's why the magic number in your construction business is 1%. Take 1%, and this is what we say in the book. Right now, even before you have the bank account set up, go set up a profit account. Even just one account. I want you to set up all 5 and do the whole system, but go set up one account and take whatever balance is in your bank account and take 1% and stick it in your profit account and don't touch it. And it will be there at the end of the quarter and at the end of the year. And for some people, doing that simple thing will make them profitable for the first time ever. And I promise you, you are not going to miss 1%. And so if you think about that, I don't care if it's you got $10,000 in the bank or you got $100,000 in the bank. Go set 1% aside and don't touch it. It's going to be there. And then when you've proven to yourself over a period of time that, yeah, I didn't miss that money, then you do it again. Do what again? 1%. Now you start taking 2% of every dollar that comes in and sticking it into your profit account. And then you need to set some percentages for your taxes and your owner's compensation and setting that money aside. And then to increase that, we recommend once a quarter, increasing your percentage by no more than 1% until you've got so much cash built up in these accounts. You can say, I can make the leap by 2% or 3%. And so a lot of people are starting at 0 for profit, for taxes, and their percentages are really low on your owner's compensation. So just start with where you're at and go to 1%. We call that the day one. So whatever you're doing now is day 0, run the numbers, and then you start with 1% added to those critical areas, profit, tax, and maybe owner's comp. Most of your money is going to be in your OPEX account because that's where it exists now. And then day 1 to what we call quarter 1 or 3 months from now, bump everything up by 1%. But what's going to go down is your OPEX account. And then operate like that for 3 months and just see how the cash goes and get back to operating your business and then bump it up by another percent. And you just keep bumping up by 1% quarter by quarter. And we go into this in the book and in my training program about how to develop your rollout plan for your business. And when you have a plan that's simple, 1% at a time, you start seeing the money differently in your business. And back to rule number 2 and rule number 1, let's say a year from now, you go from, and I've seen this happen, you go from a 96% OPEX allocation, meaning right now, 96% of all of the money that comes into the business gets spent on operating the business, not profit, not taxes, not owner's compensation. You go from 96% to like 82% a year from now. You have to realize, playing the percentage, that 82% a year from now is probably more dollars than 96% of your income now, because you're changing the way you operate, you're increasing your margins. So people thinking like, oh, we're just going to get more and more and more and more frugal. No, you're going to change the way you operate your business. And so 82% of a much bigger number is probably more dollars than it's 96% of a smaller number. So that rule number 3, if you know nothing else, everybody can start right there with 1% and just do that quarter by quarter.
I love that. Yeah. And I've found that to be true just with general habits in my life, like things that were really difficult to implement or you get started. But if you just start with something so little and you just dial that in and then you just kind of ratchet it up, and then eventually, you know, you're at your goal, and it doesn't take as long as you think, but then it actually gets done versus trying to go all the way to the finish line immediately and you get confused and, you know, it breaks down and then you just give up. So
yeah. And so you're like, are you a runner?
I try not to, actually.
Okay.
I'm a lifter.
Okay. Well, I mean, it's the same thing.
Hiking.
It's the same thing. You're not going to go out and, you know, squat. I don't know, whatever you squat now, you're always in growth mode. So I don't know, you're probably up to 400 or 500 pounds, right? You start small, right? And you do your reps and then you add a little bit to it and you don't even really realize it. Then before you know, 6 months later, but you still got to show up at the gym, put the weights on the rack and do the work. Right. But it's not that difficult to add a little bit more each time. And that's all you're doing. And you probably had those moments where you've been able to make big leaps because the strength and the endurance, the habit is established, the motivation's there. and then you can push through and prove to yourself. And that's why I always tell people, like, come up with a plan, a roll-up plan for 4 quarters, 8 quarters, whatever it needs to be, and start working it. It's going to happen faster than your plan. It always does.
Yeah, you hit the nail on the head too, because one of the most effective programs I've ever done is the 5x5, and in that program, you basically, you squat 3 times a week, which is terrible. It sucks, but anyway, each time you go in, you add literally the 2.5s, the smallest weight you can find. Some gyms don't even have them, but you add those, and so you can barely notice it. But you do that every single time, and you realize, like, after a month or two, like, holy cow, I've already added like 20 or 30 pounds to each side, or whatever it works out to be. And so, yeah, just start with something so incremental, and then it goes, because you hardly feel the difference at every next stage. So that's
and it works. Like, you have to crunch the numbers. You need to look at your expenses. You got to know what your markup is. You got to do that analysis, but you don't need to do all of that to start. Start with 1% and give yourself some time to figure out all the stuff, all of the other things in your business. And you'll see it in the bank accounts.
Yeah.
You'll see it happen.
That's awesome. And before we wrap this episode, I'm just curious, because I know you talk to a lot of construction business owners and probably get to see where people are at, for profitability. Like you said, healthy for a remodeling business might be 10 or 12%. Do you have a sense for where most people are at generally? If you just look at the industry, are they operating in the low percentages, or a lot of people negative? Is it, I don't know, where is it?
Yeah, most people, when I do some analysis, and this is kind of across the board,
Sure.
Most of them, that when they reach out to me, whatever their net needs to be, that varies, but they're charging about 20 or 30% too low. So their income is just about 20 or 30% too low to make the numbers work out. That's what I see time and time again. In general, like I study a lot of the reports that come out from Home Builders Association. They publish some things, and so they're dealing with some really big home builders, and so some of the numbers can kind of get skewed. But even taking a look at that, you got to take a look at like custom home builders with land, and then custom home builders or tract builders. They all vary a little bit, but
Totally.
In general, I can say in the any kind of construction business, if you're below 10%, you're struggling. If you're around the 5%, like, it is a nightmare. Cash flow is always tight. And one reason is because you use up 5% of your cash. What I'm saying, the 5% of your income is constantly being chewed up by operating your business. So on paper, you're profitable by 5%. You'll never see that money because it's being used on rent and on shop and on payroll and on taxes. And so below 6% or so, you're really struggling. 6 to 8%, there's a problem. 8 to 10%, you're like, okay, we got a few things figured out. It could be better. 10 to 12%, you're doing well. And then above 12%, it really gets into different industries. Like I said before, service-based contractors are probably going to see higher net profits, but they also, their cost of goods sold are usually, could be higher or lower, because on the expenses side, and I mean, if you think about a plumber that has any size of a plumbing company, several trucks out on the road, they've got to have software and people that process calls, right?
All the time.
I call a plumber. I want to call a business that's able to get me a plumber within the next couple of hours. There's a whole lot of expenses, software, people, and other systems that go into that. So you can't look at every business the same. But in general, I can tell you, hey, and the other rule of thumb is like, you are, like you had said earlier on, you're at risk. You're putting all of this time, money, energy at risk, and you're making less than 10%. Just go take that money and dump it into the stock market, and year over year, long term, you'll probably get a better result than you will running a business. So that's why I say minimum, you got to get above 10%.
Yeah, that's great. That's super helpful. And just going back to your last point, whether you're at 5 right now or 3 or 7 or whatever, if you just raise it 1%, in a year or two, you'll pretty much be at that goal, or above that goal. And so a year or two can feel like a long time, but in the grand scheme of things, it goes like that. So it's a worthwhile endeavor. But yeah, guys, this is the 3 rules, or if I'm taking over, the 3 commandments of finance. And last episode was 4 core principles and the 5 foundational accounts. So we got a couple more episodes coming your way in this series of Profit First for Contractors. Shawn, thanks again for joining me, and we'll see you next episode.
All right. We'll see you next time.
All right. Thanks, guys.